Welcome back. The stock which is in our radar today is Cigniti Technology. It's a small IT company. The stock is down 4% today. In the last 1 year, the stock has gained close to about 25%. So in a way, it has underperformed the rest of the mid-cap IT names which have done phenomenally well. We are joined by the management of Cigniti Technology. So inviting Mr. Krishnan and Venkatachary, the CFO of the company, to discuss the quarter two earnings and the outlook going ahead. Mr. Venkatachary, morning, and thanks so much for joining in. Your margins have seen a recovery on a quarter-on-quarter basis, but margins at 10.5% this quarter is nowhere close to the kind of margins you used to enjoy, which was, in the high teens level. Can you walk us through the trajectory of the margins as you see it?
Yeah, good morning and thanks for the time. On a comparable basis, I think we have given an explanation where our margins tend to be around close to 13.5 plus 14% in terms of EBITDA, and also the PAT margins have moved up. But I think there is a one-time charge of about close to 9.74 crores, which is necessitated based on the September 27th notification which has been issued by the government, restricting the cap of 2019-20 software export incentive. So the software export incentive has been restricted by the government with a retrospective effect, and that has taken an impact. And when it has come on 27th September, we wanted to price it in the books, and this has been already stated as a contingent liability as of 31st March in our annual report. And we only hoped, and there were legal opinions across the industry, that this will be carried out at the same percentage. But I think incentive being incentive, the government's prerogative, so they came back and gave a restriction on the cap and rejigging of the services, which necessitated us to really write it off. Apart from that, I think if you look at it in terms of the performance, I think we have been ranked one of the best in terms of the comparison, because we have grown 16% on the top line on a dollar basis from 36 million to 42 million. And we are buoyant for the next 2 quarters with a great order book position to move ahead. And while the last 3 years our top line growth has been at about 8%, I think this year we are expecting that to be quite phenomenally high. So definitely we are on a right track. But if you look at a standalone quarter in terms of what it is, what we promised over the last quarter in terms of looking at outcome-based contract, moving up to a managed services in a bigger level, I think that has translated out into the billability, and our winnability also has changed and the offerings have increased. So a couple of points to be looked at very clearly while I take the point to explain out very clearly is that while the last year may look at the margins on the higher side, I think every company would have done that on the margins basically on account of salary reduction, basically on account of various other cost optimization. But I think in our case, if you look through, this year has been a year of investment. We have been investing on sales, we have been investing on offerings, we have been investing on marketing. I think which is also over the last 2 quarters where we have been trying to do, and then giving a thrust to the sales. And that is which I could see very clearly, that the visibility in terms of the numbers could be as high as 30% in terms of the growth which is running through based on the current run rate, what it stands very clearly. And I think we're in a very comfortable wicket, and this is a one-off event basically, and we need to look through isolated, excluding that, I think we're on a high teens.
Okay, so you have a visibility of a 30% growth going ahead. You've also set yourself a target of $500 million in terms of revenues over the next 4 years. Can you tell us how will you be able to achieve it? Will it include some acquisitions?
As it stands today, the plan includes both organic and inorganic, but I think in terms of inorganic, I'll be able to come out and uniformly speak out as we crystallize and as the board approves, and as we start moving up to the exchanges and providing them with the information, disseminating to the shareholders. But as it stands in terms of the organic growth, I think we should be ending up the year with a run rate of about 15 million plus, which should take us to about close to 200 million this year. But I think we have a plan over the next 4 years that organically will be there from the current level where we are at about close to 350 million. I think the plans are in place. The transformation journey has already begun, and we are seeing the results of that. And the offerings have started kicking in, and the entire sales team is buoyant, and the delivery teams are geared up. So we have a plan in place over the next 4 years as to how do we get there to about a 350 million organically. The rest will fit in the bucket through the inorganic means, but which will be on a time based and which will really be put out very clearly as and when we crystallize on a few things.
That is helpful. Mr. Venkatachary, thank you very much for joining in. So that is the management of Cigniti Technology highlighting that the annualized quarterly run rate could hit $200 million by the end of this year and be closer to $350 million at the end of 4 years. We'll slip into a very short break on that note. We'll come back.